How is interest calculated on a hard money loan? By the end of this video, you're going to know exactly how hard money interest is calculated on a loan. You're going to learn how to estimate your payments and how to calculate that in the cost of your flip. Hard money loans are powerful tools, but if you don't understand how the interest is calculated, you can actually blow your entire flip without even realizing it. I've used hard money on many flips, but I've seen so many beginners actually lose money because they just didn't understand how the interest worked on a hard money loan. I'll break down exactly how the math and the interest works so you're not blown away or confused when the bills start piling up. Let's start with the basics. Hard money is a group of individuals that come together and loan money on short-term real estate projects. They're designed to help you with your flips. That being said, hard money is really an interest-only loan that's a short-term loan, typically 6 to 12 months maximum. The payments you make back to the hard money lender are usually monthly, and again, they're only interest. You pay back the principal once you sell the property. So on loans, you have a simple interest loan or an amortized loan. An amortized loan is a loan that you're probably more used to. That's what you have on your current mortgage on your house if you have one, or a car loan. They take the payments and they structure them over the course of a longer period of time. Maybe it's 10 years, 20 years, or 30 years. And they're very heavily loaded with interest up front, but you are still paying down some principal. A simple interest loan means you're just paying on the interest. You're not actually chipping away at the principal at all. You're just paying interest on that loan until such time that you pay off the principal. Now, simple interest is much easier to track. The amortized loans are a nightmare to try and figure out. That's why banks keep you all confused. But the simple loans can be a lot more expensive if you're not paying attention. So how is the monthly interest calculated on a hard money loan? Well, it has to do with how many days are in the month. So pay attention to your months. If you have February, that's going to be less interest that month. And if you're going to be a month like December with 31 days, well, that's going to be more interest for the same month. It's not broken down by month. It's broken down as a daily rate. If you're paying 15% on a $100,000 loan, essentially what they do is they say, well, for the year, so it's an APR rate, annual percentage rate, 15% on $100,000 is $15,000 for the year. They'll divide that by 365 or 366 if it's a leap year, and that will give you the daily rate. And every day that you have the money in that given month, that's how much interest you're going to pay in that month. So the big question is, what if I go over my timeline? What if you have a 6-month loan or a 12-month loan and you actually didn't finish your flip in time for whatever reason, it took longer and you have to extend? Well, hard money lenders are not in the business of taking back and foreclosing on people's homes. They can, but that's not the business they want to be in. So they almost always have provisions in your initial contract that says you can extend this loan, but you're going to have to pay maybe a point, which is 1% of the total loan, or 2 points, or maybe your interest rate will change and go up. Maybe there's a penalty involved or a fee. But usually they want to make sure they get that across the finish line without having to foreclose on the property. So there are options to extend, but it usually costs you some money. So how do you factor your interest into your deal analysis? Well, you want to take a look and say, how long am I going to own that property from the day I actually close and purchase on the house to the day I actually sell the house? Because don't forget, even the months where you're not doing any work, in other words, you finish the renovations and you sell the house, now it might take 4 to 6 to 8 weeks to go through the escrow or the closing process. That money is still not back in the hands of the hard money lender, so you're paying interest on that money. So when you calculate, figure that entire timeline and say, if I held from this month to this month, how much interest would I pay in totality on that loan? That's how you can best predict your profit in advance. The important thing is, once you have that number, to build it into your maximum allowable offer so that you are well aware of what your costs are. Here's a pro tip for you. Always build in a time buffer, because you might think your job will be done in 5 months or 6 months. You might be really optimistic and think you're done in 4 months, but build in a 30-day or a 60-day time buffer as you're doing your initial estimations so that you can be pleasantly surprised if you come in early. Nothing worse than coming in late and losing money. I'd rather you came in early and made more money by not paying as much interest to the hard money lender. Hard money only works if the deal works, and that all starts with knowing your numbers. Go watch our video, How to Evaluate a Flip Deal Like a Pro. And I'm going to show you how to evaluate rehab and interest costs. I'm going to show you how to evaluate your after repair value on that property. and how to do that in a step-by-step, very simple format. That way you know how much you can pay for that property and look impressive to a hard money lender. And that way you can always make smart, profitable decisions. Click the link right here below.